Hey everybody, great to be with you. Mike Fairborn here for Getting Started with Stock Investing. Now I'm sitting in for Kevin Horner, your normal host here. Does a great job. Expect to see him back next week. But good to be with you all today. Taking a look at the chat, recognize plenty of names here in the chat, and great to have you all here, folks. If you are here for the first time as well, definitely let us know in the chat so we can welcome you in here. I'm joining the chat by a good friend, colleague of mine, Barb Armstrong, to help out in the chat as well. So, with that, in today's discussion, I did want to take a look at really discussions, what we normally talk about in this class, and Kevin hits this, and he'll talk about growth investing, value investing, and income investing. A lot of times, really kind of blending in those three together from time to time. What we've seen recently in the markets are pullbacks, and I want to take a look at some of the value aspects of growth stocks as well, tying that value component into some of the growth stocks that are out there and really breaking that down for you on the schwab.com site. A lot of good details in there, a lot of good information. I'm really looking forward to diving into that. Today, I really wanted to specifically talk about where growth meets value. I had three ways where we can look for stocks that are growing, but also at a reasonable price, incorporating that value concept there. So with that, let's go ahead and get started. Welcome again, everybody. Let's dive into some disclosures here. Okay, so first off, information here is for general information purposes only. While this webcast does discuss technical analysis, other approaches, including fundamental analysis, may assert very different views. We're actually going to be looking at some of those fundamentals definitely today. The Paper Money software application is for educational purposes only. Payment of dividends is not guaranteed, and dividends may be discontinued. Some additional points here at the bottom. Be mindful of all points listed here, but past performance of any security strategy does not guarantee future results or success, and investing does involve risk, including the loss of principal. Now, just a quick note for everybody, if you are interested, there is upcoming, here's just a list of some upcoming workshops and a market drive events. You can register at schwab.com, just /events. You can see a few of them listed here: Detroit, Dallas, as well as Denver there. The 3Ds. Okay, well, with that, everybody, let's go ahead and get the show on the road. Welcome, great to have you here. Let's take a look initially at what's oftentimes used as a gauge for growth stocks in general, and that would be the NASDAQ 100. You can see we've had a long history of, recently, a really solid trend over the last couple of years, and we've held above this 200-day moving average. And you can see off the far left-hand side of the screen, we touched the 200-day moving average here. We touched it again, really in 2024, and here we are back again. The question is can we bounce, and will that long-term trend continue? A lot of times, folks, when we are seeing a pullback in the markets, like we see right here on our 2-year chart, we can, and oftentimes investors will look for value components within growth type stocks, and we're going to find growth stocks as well, also, within the S&P 500 as well. So let's go ahead and pull up the S&P 500. It too is bouncing off the 200-day moving average. I wanted to show you that because we do not see that every day. As you can see right here on the chart, it doesn't happen too often. Over here we have a little bit of that. And over here again on the far left-hand side, of course, this takes us all the way back to 2023, and we are touching it again. So it'll be very interesting to see what we get from the markets right here again, whether we're looking at the NASDAQ 100, really, kind of a growth index, a growth-based index, or we're looking at, the S&P 500, which also has companies that are growing. Investors do like to find stocks that have, some aspects of growth associated with them. It too, we could be looking at value. And a lot of times when stocks pull back like this, investors do look for that growth aspect combined with value. Okay, so let's do this. I'm going to head on back just to a 1-year chart as we dive into this and break this down into more detail for you. Now, as we talk about growth, the first thing I wanted to look at was growth. Now, growth itself, if investors are just looking at growth, I'm going to highlight this just on our screen here. It turns out to be a very nice pad to kind of draw on. But growth itself, growth stocks, if we're just isolating growth, a lot of investors will look for 15+% a year on an annual basis, okay? And that's per year. they'll look at that kind of growth in earnings. So that's earnings growth specifically. Now that's kind of high. I'll just put EPS or earnings per share growth annually, 15% a year. Now that's exclusively a growth stock. There are a lot of companies that grow, let's say in the single digits. And a lot of times traders like to at least say, hey, I like the 5% at least, 5 to at least, maybe 10% is an indication of growth. But what has that growth been over time? So the first aspect I want to look at as we talk about growth is the consistency of how is a company growing its earnings over time. What does that look like? Because as a company grows its earnings and it captures that earnings growth and it can grow and it can retain those earnings, called earnings retention, the value of a company can lift higher. And that's in a lot of ways how growth investors, value investors, and income investors look at stocks fundamentally to see if they can go up over time. It's been stated that on the short term, the stock market is like a voting machine, but over the longer term, it's like a weighing machine. In other words, it weighs the value of all those earnings over time. So consistency of earnings can really help to add to share prices. It's not a perfect correlation, but they can go up over time as well. So that's something to be mindful of there, consistency. And that's really the first point I wanted to bring up. Let's go back to our chart here. I'm just going to pull up Apple here as well, because I want to reference Apple as we go now into Schwab.com. So let's do that. I'll pull it up right now, and here we go. So this is what we're at on Schwab.com. And how I got here, first of all, it was just Schwab. I just went to Schwab.com. When I signed in, I went into research. Okay, so I went into research, and then I typed in the symbol, is what we do. So we do research, we typed in the symbol, and you can see I've already typed that in here as Apple. Okay, now we want to try to use this platform. There's a lot of great information on here. You can see information off on the right-hand side as well. It can be very, very helpful. I'm just using Apple as an example here. But how has Apple done historically on its earnings growth? Investors really focus in on this because if a company's had that growth in the past, well, then there might be the tendency to keep growing into the future. In other words, you've seen the stock trends that are higher over time. Now we're looking at earnings trends that are also up. Higher highs and higher lows collectively as earnings. So what you want to do when you get here, and this is referred to as the summary page, we can type in any symbol, it'll pull us up to our summary page. We can just scoot on down, just scroll on down. A lot of good info in here. You got news, dividends, earnings right here. Now, the first thing it's going to show us over here on earnings is we do have, and it does default, to quarterly earnings. And you get a good reference over the past 4 quarters, what those earnings have done. So you can see over here, earnings have been, kind of flat to up. And all else equal, that's a positive, but that's only over a 1-year time frame. A lot of times investors are looking at a 3 to 5 year average, okay, as we go through that. So what we want to do in that case, to get the annual numbers, is we want to click on the show more right down below here, as you can see. I'll click on that, and that's going to provide us an annual reference point to what those numbers have been doing over a period of time. Now, we do get a bar graph up top that does show us, let's just highlight this. So we can see what that growth has been from 2022 to 2023 to 24 and estimated 25. Okay, more on that in just a second. But as we look at this, that shows the percentage growth. You see us going higher now, not just over the past 4 quarters of the last 1 year. We're going up annually. And this is a really important point for individuals that are looking just actually for any kind of growth. They want to see growth. What did this grow? So did this grow at 15%, Apple? It did not. 10%. Expected to grow at 8.7% over here, below the 15%. But seeing that it's had a tendency to grow in the past is a really key point. Now, I want to draw your attention right over here, the year-over-year growth, because on Schwab.com, you get something great over here. You get the annualized 5-year growth rate. It's listed right there. So this was the year to year. We were looking at the 8.7. So we've got 8.5 over here, but down below, it gives you a trajectory, a record of what that growth has been over here. You can see it. Okay. And you've got that listed right there to take a look at. Now, this actually is, I'm sorry. So this is, we're looking at revenue over here. I think it's just year over year revenue. Annualized 5-year growth rate revenue off to the right-hand side. We were talking about earnings. Now, revenue is a key component because if you're seeing revenue, it's just a quick check. I wanted to highlight that. But you can see that you've got revenue growth numbers, you've got cash flow growth numbers. These three all factor in together as one. And it's just really nice to kind of just see that same kind of trajectory. You know, it can be sideways, but generally to up. A little bit of growth, as you can see down below here, that was 1% in cash flow, but then there was a big increase over here. With that increase, look what happened in 2025. You know, we're seeing the stock price behind the bar graph over here represented on each of these. So you can see as prices have grown, as earnings per share have grown, as revenues generally have grown higher, as cash flow has grown higher, what has happened to the stock price? And I'll tell you right now, this is a reflection of what has been happening. If we were able to scroll back here and look at Apple the prior 5 years, you know what we'd see? We'd see something very similar. We'd see the growth going higher in these earnings, revenue, and cash flow. Just generally speaking and collectively, they've been going higher, and that's helped to facilitate share prices going up as well. So the consistency of earnings plays a really, really key role. And that was the number one thing I wanted to talk about, is the first key way to talk about growth. Now, the next point I wanted to bring up is estimated growth. You have it right here at your fingertips, and that is what is expected in that upcoming year right there. We don't have this on the Thinkorswim platform, so that's why it's really important to utilize Schwab.com to see it, to actually see that growth coming in. And there you have it right there. Is it expected to go higher or not? Because that can be a real driver for potentially for share prices as well. If earnings are expected to increase too, well, what might happen to share prices if the company keeps growing? Right? We talked about that concept. Value would be being increased over time. The value of the business is just worth more. And so it might, carry with it over time a higher share price to reflect that value. Okay? So not just saying what's happened in the past, but also just getting a quick reference and saying, okay, what are the expectations? Now, it is an expectation. It's not a guarantee. In fact, if you look close, it's hard to see, but it does say 2025, and there's an E right there, and that E is an estimate. It's an estimate. Okay? But a lot of traders, I should say investors as well, will look at, they want to see what the expectation is for that growth. If there has been historical growth, they feel much more comfortable saying that earnings expectations or earnings estimates are going to be higher as well. So what I wanted to do, because that was the second component I wanted to share with you, but what I want to do right now is I want to tie in an additional aspect and keep building these, because we can create a wonderful screen over here on Schwab.com as well. I'm going to take you right to that now. In fact, let's just do this. I'm going to show you where I went to pull this up. I've just switched tabs up top here, but I'm still in Schwab.com, and I've gone under research as well. And under research, I'll click on that. I just went under stocks. When I click on stocks, you can see it right there, the stock screener. So let's line these up right now. Earnings per share, historical growth. Where has that growth been at? Let's pull it up. So we can see a number of companies maybe in an index over here, which is what I wanted to do. So right over here in an index, you can use different exchanges, but an index might be the first thing. Very important to know what you're looking up. And we've got a few selections to make right here. I'm just going to choose the S&P 500. You've got the Dow, you've got the others. One of these S&Ps is the mid cap. You've got the Russell, a lot more stocks over there for the small cap side. But I'm looking at some of those maybe a little bit larger, more established companies right now. So I've got this built in, but let's tie in what we just looked at over here in terms of that earnings consistency. We want to see what that growth is, but actually be able to pull up companies in the S&P 500 that meet that. So we can do that over here on the left-hand side under, right there, It is company performance. We just click on the plus sign right there and we can pull it up. Now, it is important to note that it does list revenue up top. So you got to come down to earnings history right there. So I want to do, we can choose either a 3-year or a 5-year. A lot of analysts will use a 3-year, but some do use a 5-year as well. I'm just going to go ahead and select the 3 for now, and we can come up top here and we can put in a specific value. And I'm just going to say it's going to be greater than or equal to, we'll just say on the bottom end, at least, let's shoot for 10% initially. So we're looking at that earnings per share growth we talked about over here, but going over the past 3 years, we're pulling up at least 10%. Okay. Now, as we come over here and we say, well, what about the estimates as the part 2? Let's just make sure that, hey, yeah, earnings are going well, but in terms of what the analysts, I should say the executives of the company have been communicating with the analysts and just what the analysts are coming up with as well, what does that estimate look like? Well, we can come down here and you can see estimated earnings per share growth to try to kind of confirm that. So what we want to do down here, let's go ahead and look at the next fiscal year. Okay, there's been a lot written about the fiscal year. In other words, what does the next year look like relative to like the longer term 5 years? That can get really tricky if you're getting into the growth stocks. It gets a bit challenging when you go out 3 to 5 years, for example. It's difficult. A lot of those estimates tend to be overly optimistic, and executives really don't guide out, and they really understand the company the best. They don't tend to guide out 3 to 5 years. So a lot of that is just the analyst bringing in kind of their opinions and whatnot. So I'm going to go ahead and just click on next year, where the executives do generally guide. And let's go ahead and set this up. I'm going to go ahead and just say I want an estimate to be at least about the same. So greater than or equal to 10 over here as well, 10%. Now, what's that going to do? That's going to knock out, we've got 118 matches now. So we've actually looked at earnings growth at least 10% with an expected 10% into the next year. We've only got 118 out of 503. So we're already making some pretty good progress in terms of narrowing down what we kind of wanted to see over here in terms of the general visual, earnings going higher. We could run one for revenue as well, but I just wanted to focus in on earnings at this point today with you. A lot of great tools in here to look at. Okay, so we've got 118. All right. Now, the next thing we want to talk about, I'm going to go back to our chart over here as we pull this up on Apple, is what we could look at is also, hey, where does the company stand in terms of what investors are paying for the price of the company relative to its earnings, or in other words, the PE ratio. Let's pull that up right now. So this has been noted as being the most popular, or most common fundamental metric out there. It's really just a valuation metric. And what it compares, I think many of you are familiar with this, but just a quick note. So it looks at price, as a relationship or as a ratio to earnings. So what are we paying in terms of price relative to the earnings of the company that they're making? Now, strictly on a value, so value investors themselves, I'll just type this in. So value investors, these are just general guidelines that might be benchmarks for some investors. A lot of times what they're looking at is, they might look at a PE ratio actually as low as 5 up to maybe 15. And they consider that to be, a good value, what they're paying in terms of earnings to the company relative to where the price of the stock is at. Okay. Now, it does tend to be a little bit higher for growth type stocks, but a number of investors will look for growth stocks, which is what we're looking at today, really being, where they might kind of bottom out. Potential benchmark could be between 20 and 25. Now, why would that be the case? Well, they're growing. There's just more growth expected over here. Growth is a really interesting concept. If we're growing higher into the next year, then the value of a company that we're buying today might be cheap relative to what the growth could be into the future if there is growth. value stocks might not have a lot of growth. So what you're buying today relative to 1 year's projected growth or out further in time might actually be expensive, comparatively speaking. So that's one of the key reasons why growth can carry with it a higher PE ratio. Okay, so with that, a couple of points to note. Let's go ahead and just take that off for now. We'll jump back over here. Folks, if you like this kind of content, uh, and this resonates with you and it makes sense, appreciate Barb's help in the chat as well, definitely. But yeah, love it if you just smash that like button. It just lets me know that this kind of content is useful for you and it gets the word out as well. While you're at it, bottom right-hand corner of the screen, we'd love to have you subscribers to our Trader Talk channel. If you're not already a subscriber, that is, I think many of you are. If you are, be careful not to hit it again because it might unsubscribe you. But just keep that in mind. You can go right here. I'm going to actually throw this link right in here to our box down below, and we'll get that all set up. There you go. So there's your Trader Talks right there, link, and you can get into that too. But if you subscribe, you'll have access to that. And we have a ton of different playlists in here and would love for you to join in. Okay. All right. So with that, let's do this too. I don't think, oh, there is a survey. Yeah, there's a survey link as well. So if you wouldn't mind hitting that survey sometime during our discussion, you can't hit the link after we're done. It's got to be during the discussion. You can fill it out after, but I believe there's only 2 questions in there. I mean, if you found something useful or helpful, love to hear, or any topic requests, would really appreciate that as well. All right. Well, having said that, so where have we gone? So we've talked about a couple of different points. We know what we've got lined up over here in terms of our scenario, our setup. We've talked about earnings growth, the history, making sure that there's that consistent earnings growth over time. We also want that earnings growth at least expected to be into the future as well, maybe growing at the same rate. It could be growing a little bit lower or higher. I'm just using 10% here. But now we want to incorporate the value component. Let's look, because we are looking at growth, but the PE ratio, as we just mentioned, for growth type stocks, that might be on the lower end. And sometimes traders can go higher, investors could go higher too. I mean, as I said over here, 20 to 25 on that number in terms of a PE ratio, specifically around growth. Okay, growth. I want to make that clear, because if it's just strictly value we're looking at, it's going to have a much higher requirement in terms of the PE ratio. In other words, a lower PE ratio. But for growth itself, 20 to 25 on the lower end, I've seen traders, though, do this. They'll say, hey, you know what, Mike, that's still low, because some of the growth that we're looking at is super high. So they might expand this out to 35, 25 to 35. I've seen that done. It's just a general benchmark to take a look at. But let's dive in and take a look a little bit further into this. So what I want to do next is I'm going to click on the company performance. I'm going to minimize that. I'm going to click on valuation now. And here is our PE ratio. Perfect. Okay. Let's click on earnings, enter a specific value. And what I'm going to do is I could say something along these lines too, because maybe I want to say, gosh, is it possible? And I've seen this from time to time. It is quite rare to get, some good solid growth over time, especially above 15%, that has a PE ratio of 5. I have witnessed that. Sometimes there's good reasons why it's cheap, and sometimes it actually is a very interesting value. So I'm going to go in between and use the lower end of our scale that we looked at for value stocks specifically. And I'm also going to go to 25 over here. 51 stocks. So it's a little bit more manageable. What are we at now? We've knocked out about 90% of the stocks. We're right down to about 10% for the PE ratio at this point in time. So I want to pull up these companies right now, because these would be considered companies that have with them growth. There's an acronym for this: growth at a reasonable price. Now, it's a funny kind of an acronym. It's GARP investing, growth at a reasonable price, showing you that the Schwab.com site is so easy, so quick to set up a GARP type search. There's a lot of power, a lot of capabilities here to do this. And let's go ahead and run it right now. Okay, I've got a bonus one for you that I want to take a look at in just a second too, where I want to take it to another level. But in the meantime, let's do this. Let's see what companies we have over here that came up that matched our criteria. Okay, so what do we have? We've got earnings per share growth, last 3 years. Perfect. Is everything greater than 10%? So 10% or higher, right? That was the mandate actually across the board for these, well, for here and here in the earnings per share. So it looks, I'm sorry, the price to earnings ratio. So consistent history of growth, expected growth, and where does that price ratio, the PE ratio fit? The beautiful thing is folks, they all fit. They all fit. One, two, three. That's the part, that's the key part of the screen that really helps us cut through, I mean, so much additional work. I mean, imagine going through and actually pulling up this data on the summary page off 503 companies for the S&P 500 as it stands right now, and just lining all these up. That's the way it used to be done. But now you have it literally at your fingertips. This can be exported and put right in to the Thinkorswim platform, which is what I want to do next. And this is just true with any screen that we're running here within Schwab.com. We can import it into the Thinkorswim platform. All right, let me just take a quick look at the chat and see how we're doing. I think we're doing very well in here. And yep, let's see. Awesome. I think we're all caught up. So let's do this. Let's go ahead and do that right now. So the next thing is really looking at the stock charts themselves. How are they doing? I know many of you guys that are in this group right now are very, very good at technical analysis, but it's really kind of the next step is now that we've got this aligned, we want to also tie this in together with technicals where the fundamentals and the technicals align together, right? I mean, obviously, if we're seeing a company who's got a stock that is going like this, but yet it has good fundamentals, well, that's something that we might want to keep an eye on. In fact, you know, Thinkorswim does have the capability to set alerts on stocks. So if the stock starts to break above a prior high or whatever the case might be, alert us, email us, text us, let us know. But this can be like a prime group of companies to keep eyes on. Whether the trend's up or not, sometimes that trend will flip and it can be a strong turn. Let's do this right now. So I'm going to go ahead and export this. I'm going to click on that and I'll pull that up. It did pull up in my Excel folder. Let me just get this going here. So let's see. I'll click on that. Oh, it's going to pull up on my second screen. I'll go ahead and show this to you anyways. So we've got it. Let's see. There it is. Okay, so this is what it looks like. Excel right there. And you can see it does list on Excel, which is really nice. It gives us each of those columns so we can save that data if we wanted to as well. I'm interested right now in just transferring the symbols over so we can take a quick look at the charts. I'm going to highlight column A. I'm going to right click. I'm going to copy that entire column so we have that. Now we're going to head on back to the Thinkorswim platform. And what we're going to do is I'm going to close this for now. I'm going to go ahead down in the bottom left-hand corner of the screen, click on the plus sign in my gadgets window, go right to a watch list, pull up that watch list. We can leave it as default for now, but I'm going to create a watch list right here. Create the watch list. With this, you know, I've already copied that column. So all I need to do now is simply import it and click the import button. Click on import. I'm just going to simply want to paste those symbols and there they are. We got them all there. So all 51, you don't have to go through and you don't have to, oh, we'll name it. And we'll just say GARP screen. And a lot of times I like to date these two to put a date behind it so I know when I did it. So we've got that there and voila, it's that simple. And now we've pulled all of those stocks over so that we can quickly have access, folks. I can't tell you how nice this is to be able to have these tools to look at with whatever indicators you want on the chart. Go over here, this drop-down box where it says, you can see the chain. Just go down to the red so you can link it. Notice it's red. The red is linked, and it's linked up top to our other red right here, right there. And so with this, we can go through and take a look at some of these companies. Now, right now, you can see it's just put everything in alphabetical order, but there are now 51 companies that came through. If I just click on Abbott Labs, for example, you can see right there where we're at. Now, looking at a company like Abbott Labs, that I believe is still, yeah, it's a dividend. I believe it's still a dividend aristocrat. It's raised dividends each and every year for the past 25 years consecutively. It might be a dividend king up to the 50-year mark. Don't quote me on that. I think it might be. But you can see it's got maybe an income component as well. But oh, there's a little bounce off the 200-day moving average. The whole idea here is take the concept that you guys have had previously. What do you use? Well, we know, and many of you are so good at this, you use the trend, right? You use the trend. Is the trend up? Okay. How about my indicators? I'll just put IND for short. I'll be out here spelling stuff all day. But there you go. So the trend, what are the indicators showing? Because what are we looking at on this company? We can tell you right now that over the past 3 years, this company right here has had a 10% or more growth rate. And we actually have those numbers. We actually have them on an Excel spreadsheet as well. We know that they're projected to grow higher next year. And we know the PE ratio fits within our range. That's despite the strong move to the upside. So after we've gone there, let's align technicals with fundamentals, okay? Because this search is a GARP type search. A lot of progress is made very, very quickly when you have these kind of tools at your fingertips. So let's do this. I'm going to go ahead and just show you, like, for example, here is Alphabet. Now, Alphabet has been a growth stock. It's been strong for a long period of time, currently below the 200-day moving average. You can see over here, we've dipped below that previously. We bounced back up above it. Will we get that again? Well, that's the question. We don't know if we'll see that, but we're right down to this level, and we might get a little bit of a bounce. Okay? Does it have the growth? Does it have the growth projections? Let's pull it up. Boom. Where was Alphabet at? Right there. It's expected to grow. It was at 11%, so double digits, 14.5% expected growth rate, and into next year for the year. And then you've got the PE ratio right there at your fingertips. Okay? And then you've got it. And so this is interesting because, a lot of times fundamentals, they do from time to time, they can put kind of structure behind the trend. Do you have an additional reason why prices could go higher? Okay. Well, I really wanted to make that point clear today because we're talking about stock investing. These are just tools that investors will use to help them be on the right side of the trend. Maybe having a higher expectation of that trend, continuing higher into the future is the idea. Okay. Now, could this be a possible entry point for an investor if we get above the 200-day moving average? Absolutely. It could. In fact, notice we've swung down this range and prices have come up over here. Well, that is an area where there could be an expectation for prices to possibly jump up if it goes above that level. Watch this. I'm going to right click using my mouse, just right click, and go down here to create an alert. I want to know when Alphabet is going to break above the 200-day moving average where I have it sitting right now. So let's just say this. I'm just going to say breakout above the 200-day question mark. I'm going to click on create. And now this can be monitored for me because we might actually bounce off, let's say, for example, a support level. And let's see, right through here, for example, around the 200-day moving average and support. Can we get above that level and go higher? That's the question. The long-term trend and the long-term trend of the fundamentals, which is how the stock, this is why we're looking at it in the first place, has been up. You can see it's gone above, went below the 200 a couple of different times, and that has tended to be a pretty strong bounce area. And that could be a potential entry for the company if there was an expectation of it going higher. Now, that remains to be seen, and you guys have a lot of technicals that I know you look at specifically. I know you're good at that, but this is just one way to combine those together. One thing I wanted to do, because it does matter, if you did get a bounce that came up here, a lot of traders will have a number of different rules and different areas that they'll look at in terms of how to trade a bounce to the upside. That's actually one concept, and I just went through a number of rules that a lot of traders might use for a bounce trade as well. If you're using fundamentals as an additional, possible driver for prices, higher in the future, you can use something like, for example, swing trading. I do teach a swing trade class, and I do this on Tuesdays. I'm just going to throw this in for you into the chat right now. If you're interested in that, that is the link for the swing trade class where we talk about specific moves to the upside, how to trade those entries, potential targets with price patterns and exits, things along those lines. Okay, so I'll pull the, oh, sorry about that. I'm just going to pull this back down. Okay. Oh, and let's see, I should note this too, just as a quick note. The class that did do that, I'll just put that in because this is the actual class that I taught that had that. So this is the swing trade right there, where we went through some of those rules. But that could be, some additional rules you could look at for trading the move to the upside, just as a side note. Okay, so with that, how are you guys feeling about growth at a reasonable price? It's not too bad, is it? I mean, in terms of what Schwab does have, the screener, fascinating. This is a great way to set this up. Now, as I mentioned and showed you over here too, there's a lot more in here than just earnings. I mean, there's revenue, there's cash flow, easy, quick checks to look at in terms of history and expectations. But also here on the right-hand side, additional information. So I'm just saying there's a ton of things that you can get, a ton of great information that you can get right off the summary page here. Okay. Now, I promised you a bonus today. Now, there is a ratio out there that does some very, very interesting combining. I'm going to go back to my, well, this is kind of like my whiteboard. It's clearly a blackboard, isn't it? Let's go back into this. And I want to talk to you about using a couple of different components. What have we talked about today thus far? We do know we had, historical growth, right? So let's just type some of this in. Historical growth, we talked about that, right? We had historical growth, really important. What's the consistency of that historical growth, right? We talked about projected growth. Projected growth. You know what I'm going to do? I'm going to tell you what I'm going to do. I'm going to erase this, and we're going to actually type this out so we can get this out. Let's say on a sheet that we can actually see a little bit better. Let's just do this because I think this is, I was going to draw some arrows, but I can still do that regardless. I'm just going to do this right now. So a couple of things we looked at today. So we talked about historical growth. That's so much easier, right? And then we said, hey, with that, as a part two, we could say, well, how does the projected growth look relative to the historical growth? Okay. In addition to that, we said, well, what about the value side of things? Where is the PE ratio at? We talked about a couple of different price to earnings ratio, right? Price to earnings ratio to earnings. Okay. Where does that fit into the mix as well? Go ahead, just get this a little bit bigger for us so we can see that. We'll bold it out. Okay. That's the PE, and there we have it. That's kind of the setup, right? These two upper portions were really tied into, let's do this. So this was growth right there. All right. Underline this, and we'll underline that. Building up kind of our GARP concept. Now, we can take pieces of what we've got here. In fact, we could look at projected growth and say, hey, what's the projected growth like? And what is that projected growth like relative to a company's PE ratio? Interesting. What are we paying for projected growth into the future? This is really kind of a growth ratio that a lot of traders and investors will use. It's referred to as the PEG ratio. I'll go ahead and just write this in. And what it is, it's actually the price to earnings ratio divided by the, got to put a projected in there, projected growth, earnings growth over here. And that's what the PEG ratio is. Okay, so that's what's going on. So I'm going to put this over here. Let's just do this. I'll type it in. So the PEG ratio itself, PEG ratio is the PE ratio divided by projected EPS. Okay, what's fascinating about this ratio, in a way to help us quickly find growth at a reasonable price. Of course, you want us to look at historical. I think there's a lot to be said for historical earnings as well. You know, that consistency, and that could be easily added into a search with the PEG ratio. But what we're looking at here, as you can see, what is the PE ratio relative to the projected EPS? If that number is less than 1, okay, that means that what people are actually paying for the earnings of the company right now are actually cheaper than the expected growth rate. And that right there should send off some alarm bells. If we get a PEG ratio that's less than 1, people are paying the current price relative to earnings is actually lower than the projected earnings growth rate. And as long as they meet that projected earnings growth rate, it's going to be growing faster than what they're paying for earnings right now relative to price. So it's a really interesting ratio that we've got over here as kind of a final note here on our screen before we're all set. And you can find that right down below, right here. In fact, I'm going to run a separate search altogether just using this on the S&P 500. So I'm just going to duplicate this tab. I'm right in my stock screener again. I'm going to go back into my basics. We chose the S&P 500 right here. But remember, we don't really necessarily need to have the projected annual earnings rate, and we don't need the PE ratio because we have one ratio that actually does it all. That's right here under valuation. It's right there at the bottom. That's the price to earnings. And the growth, again, though, it's projected growth, as you can see right there. It's growth. It says growth, but it's not historical growth. It's projected growth. I'm going to add that in and show you how many companies in here are priced right now, what people are paying for the earnings of the company are lower than even what the earnings are expected to be next year. You could maybe see the value plus growth, right? It's a combination of the two in the mix. There it is right there. We got 39 companies that meet that criteria. Now we could also add in, like we did before, under company performance and just say, well, give me a consistent history of earnings, 3 to 5 years or whatever the case might be. But this does a lot of the groundwork for us in terms of the growth rate. I'm going to click this on right now and show that to you. These are those companies. You'll recognize some of those names, but it's kind of more of a little bit of a select group. Maybe there's some opportunities in here that are showing you, because they are less than 1. So it's saying growth rates higher. In fact, we can prove it. What we could do is we could pull up the growth rate and the PE ratio and compare those two, just like I'd shown you previously. That could be done right over here. So a lot of great tools. I'm so happy I had the chance to share them with you today so you can start utilizing the tools on the platform and building relatively a good an inventory, I should say, an inventory of companies that have both components where growth meets value at a reasonable price. An indicator like this is kind of our bonus one, our ratio here, I should say, the PEG ratio. Can help you do that too. And you can kind of dive in and find out what's going on with the company. Why is it expected to grow more? And why is it so cheap right now? And is there within that an opportunity for me to participate? Of course, you'd want to export this too and take a look at those charts as well. Okay. All right, everybody. Well, thank you so much, Barb, for helping out in the chat. She's been very, very busy. Again, definitely give us a follow on X if you haven't already. Barb Armstrong CS, Mike Fairborn CS. Would love to have you guys join us on board there. I'm going to go ahead and just throw that out in the chat so you have it, but there is my handle right here in case you're interested joining us on X. Remember, Barb Armstrong CS as well. Be sure to give Barb a follow. All right, on that note, folks, again, if you liked today's presentation, if you found it useful, effective, really appreciate it if you'd smash that like button, lets me know. Be sure to hit the subscribe button too, and there was a survey that Barb had thrown in many times. And so if you're able to fill that out, that'd be fantastic. All right. Well, it was great being with all of you. I hope this is very informative and useful, and you can use these tools going forward. And with that, have a fantastic rest of the day. We'll see you.